Abhishek Bhardwaj is joining us from Green Lantern now to talk more about markets. Abhishek, thank you very much for your time. I want to understand from you the entire the environment right now. All stocks have been rallying very hard. Do you think that market will find ways, but actually it is its own weight what will bring the market lower right now? We have started discounting growth way ahead into the future, and that's how that kind of a rally is not sustainable.
Yeah. Hi, Ajay. Good afternoon, and thank you for inviting me on the channel. To some extent, here, I think you are right. Markets, since they're trading at relatively on the expensive side, at around 20 times forward earnings, 1 year forward earnings for Nifty, it's almost one plus standard deviation higher than the 10-year average. So, no denying the fact that it is trading on the expensive, relatively on the expensive zone. I think where we are seeing more challenges and where Nifty is seeing higher challenges is also an area where there is higher ownership and higher expectation. Something that we have seen with HDFC Bank. I think there were certain expectations from the bank and ownership. Of course, this is one of those favorite stocks which has done so well for a very, very long period of time. Market has been concerned about the NIM pressure on NIM margins, which market perceives will only increase going ahead from here on. So, given how markets are positioned, we are seeing, despite valuations now becoming reasonable, I think there is significant ownership in the stock. Also, I think incrementally what we are seeing and what market has suddenly started is market was perceiving during this period, we may not see credit costs as a concern because recoveries have been very strong. On the gross slippage side, we are seeing some concerns. We are seeing that some banks are reporting higher gross slippages while recoveries remain strong for the other part. But there are certain slippages, and that has also brought about some concern for the sector. That's on the banking sector. Overall, also markets, the part which was always liked with the market, where ownership remains strong, where valuations are on the higher side, I think that is where seeing more pressures. As we all know, there is hardly any margin of safety, and if there is a slight underperformance or disappointment, the stocks are being punished. Some of the favorites on the consumption side that we are also seeing banking. So yes, there is certain challenges. I think from our perspective, we focus on areas where there should be earnings acceleration, and that's been our focus and on the markets. So
Let's talk
yeah.
about some of the engineering and capital good space, especially from the uh, so smaller or mid cap basket, which actually feed into the power reform theme, because
Correct.
big generation companies are making much more power than yesterday. That needs to be transported. That would require transformers or big, there's a lot of infra capex boom happening, especially on the renewable side. The spades of that industry, the company which are actually helping achieve that kind of capex, big earth movers, big equipment companies. Do you think the earnings growth even from here on, many of these stocks have done well, can still be supportive of the stock price movement? Because if earnings growth have a 20% plus 25% kind of a visibility next 3-4 years, stocks will have cushion. What are your thoughts there?
Correct. Correct. So I think a very good question. You are focusing on almost an area where we see a lot of opportunities. So energy as a segment over last many years was ignored, and some of these stocks were actually trading, particularly on the fossil fuel base, they were trading at as if there is hardly any terminal value. What we have realized and what markets have realized over last 6 months to a year, and more recently, when power demand increased significantly, that India will remain energy starved. And there are many drivers for our energy demand, including our focus on manufacturing, which is far more energy intensive as a economic growth driver versus the services sector. Even some of the new age industries like data centers, if it's a AI based data center, AI driven data center, then it's far more energy intensive. And I think demand for power in a country like India, given our focus also, will continue to be significantly higher than what we have seen in the very recent 6-7 years. So it should grow at 6 to 7% per annum, and we have not invested for that. So we remain positive on in the entire chain. We are so as a country, we are investing a lot on the renewable space. Globally, these investments are happening. Then we will have to increase capacity on the base load. And so generation is one part. Since we will have to increase generation, and particularly on the renewable side, the place of generation will have to be different than what it is for the fossil fuel based, which are usually pit head plants, and renewable would be where there is either sunlight or where there is wind on the coastal area. So we'll have to create a different grid, a newer grid, and a lot of investments has to go into that. We see that this is at least a 7 to 10 year theme. We'll have to continue to invest. Over last many years, we have not invested. Players in this segment have either reduced capacity or have actually closed down. So some of the enablers, say even in transformer and other areas as well, transmission companies, there is reduced capacity and increased demand, which should lead to all the drivers of earnings growth, which is sales should grow, gross margins should increase in this segment. There should be operating leverage. And since there is significant visibility in these businesses, we should see a multiple expansion as well. So that's an area of interest for us. And you're right, it should continue to see an earnings acceleration.
Have you started looking or working towards consumption, be it consumer, pure consumer, FMCG type of companies have seen very weak volume growth. In fact, the entire segment at the lower end of the K-shaped recovery we keep talking about, be it QSR, consumption, apparel, retail, all of them have been very weak, anemic. But the good part is that even the stocks haven't really moved. In fact, they are pricing in the worst. Does it provide good hunting ground? Risk reward is attractive there?
So we have selectively started looking at the space. Some of the areas still valuations are not very comfortable. And the other important part is, I think we will see a very different demand environment in India, wherein, and it's something that we believe is here to stay, wherein you will see a relatively stronger urban demand and weak rural demand, something which is visible in the near term. So keeping that in mind, we will have to be mindful of the businesses and stocks that we select. Also, valuations on some of the larger names are still not where we would want them to be. But there are certain areas in the branded apparel or durable side where one could selectively start looking at, because there is some reduction in cost pressure, and there is a case for improvement in margins to some extent.
All right, Abhishek, we'll let you go on that one. Thanks so much for joining us on the show today. That was Abhishek Bhardwaj of Green Lantern talking about the way they are analyzing the market. They are overall cautious, but there are select areas in